We Company, meanwhile, is a parent of shared workspace startup, she said, WeWork. Got that? They're holding their pre-IPO presentation for analysts in New York today. Can their business model justify a sky-high valuation as they seek to go public? Atish Davda is here with me now. He's the founder and CEO of EquityZen. So, Atish, what is WeWork, or the We Company, up to today?
You know, I wish I could tell you. The We Company's business model effectively is pretty simple. It leases buildings and then rents it out in smaller pieces. That's not a new business model. That's a real estate company. What's new about the We Company is that it's pitching itself as a technology firm. And the way it says it's going to do that is by using machine learning and a lot of other software. It's going to help folks optimize how they build and operate offices. Now, the way I think about it is, if it's the worst case scenario is that it gets pegged as a real estate company.
Okay.
In which case it would be about 20 times overvalued than its last private round of $47 billion.
Okay.
The best case scenario, the way I at least hear what they're saying, is we're going to put all these gadgets and sensors, we're going to track what everyone's doing. Sounds to me like an Amazon warehouse. They're trying to turn our offices into an Amazon warehouse in order to get the tech valuation. And that's the best case scenario. You know, I don't buy it.
So all of this is happening as they get ready for what reportedly could be about a September IPO. And this is probably one of the companies with the most high-profile criticisms of its business model as it prepares for that. I mean, even Uber and Lyft did not necessarily have the heat on them like WeWork. Has it affected their valuation in the private markets?
Well, you know, their valuation in the private markets has continued to go up. But what's interesting about this is something we hear about with WeWork or We Company that we didn't hear about with Uber and Lyft is the amount of capital that the founders have allegedly taken off the table in secondary sales. You know, with every one of these rounds, the founders can take a few chips off the table. This happened when Snap went public. You know, the founders of Snap had taken tens of millions of dollars off the table. We're talking about an order of magnitude more that has already gone in the pockets of the founders here, which is over $500 million. And that's a lot of money that they are effectively just holding on to risk-free because they sold it on the ride up.
Do we know if they're looking at IPO valuations now as a quote-unquote down round? I mean, are we so you said the last they were valued at was $47 billion. Are we still expecting them to do much more than that when they go public, or no?
You know, I think they're going to at least try and match that number. We'll see what the analysts today and Wall Street over the next 3 months actually decides to accept. You take a look at all of WeWork's competitors. I mean, their price-to-sales multiples are between 0.5 and 1.3. Trailing 12-month multiple for the We Company, I'm going to have trouble saying that over and over again, is 26 times.
Wow. Okay.
So, I mean, you're talking about something that its peers are being valued one way. This company's being valued 20 times greater. For the sake of all the people I know that have worked at WeWork in the past and still work there, I hope I'm wrong. But I just don't see how it can, by acquiring a few tech companies here and there, turn itself from what's effectively a real estate firm into a tech firm.
That's well said. Atish, thank you.